Hi guys, welcome to another video. So in this video we are going to discuss about the financial model of the JP Morgan. So it's an investment banking company and we will discuss about the each and every aspect of the financial model for that. So you are seeing on the screen. So this is the index sheet. Then we have the first tab, it's important company info. Then we have the summary of the financials and the capital ratios. Then we have the capital, it's a tier 1 and the tier 2 capitals are there. Then we have the loans calculation is the total loans. Then we have the loan reserve calculations, financial statement and supporting schedules. First one is the balance sheet, then interest calculations, income statement, cash flow statement, dividend and stock repurchase. Then we have the valuations is the public comparables, dividend discount model, cost of equity calculation. So these are the numbers for that. So let me go into the first number. So we'll go to financial statement or the income statement, particular income of the company, and first we data on the data. So let's say we go in the data tab. Then we have the company name is JP Morgan. The ticker is JPM. Last historical years is 2013 and valuation date is 2013. And where we are doing the projections for the later years. Monthly multipliers, days in the year, conversion rates, and the stock options and RSU informations. Then we have the common share outstanding and the current share price. Then we have the options, RSUs and diluted shares. Then blue indicate the hard-coded numbers and inputs. Black indicate the formulas. Green for the linkage and the minimum tire common capital, etc. Then we go into the summary. Let's say we go into the income statement as well. So this is a non-income statement or non-interest revenue breakup. It's a investment banking fees, first one. Then we have the principal transactions, security gains, lending and deposit fees, asset management, mortgage fees, credit card income, and the other incomes are also there. Then we have the interest income and the interest expenses. So this is the total net revenue for that. So that is the sum of the total non-interest revenue and the interest incomes. Then we have the provisions for the credit losses. Then there's a non-interest expense is a compensation expense, occupancy expenses, technology and equipment, professional services, marketing, other expense, amortization of intangibles, and merger cost. So these are the some of the expenses are there. So it's a non-interest expenses. One thing. Then we have the income before taxes and gains. So this one is that. Let's say total revenue, provision from the credit losses. Then we have the non-interest expenses minus. Then this is the income before taxes and gains. Then we have the income tax expense. Then we have the NI before the extraordinary gains. Then these are the extraordinary gains are here. Then we have the discontinued operations and net income is there. Then we have the preferred stocks or the accelerator amortization from the TARP, undistributed revenue, and net income to the company or the common. Then we have the weighted average basic shares and what other shares are there. Then we have the weighted average diluted shares for a particular company. Then we have the ending common shares. So these are the common shares for the particular company. Then we have the EPS is a basic EPS or the diluted EPS one. Then we have the dividend per common share. So this is one. So these are the drivers for the particular growth of the revenue. So first one is the investment banking percentage growth. So this one is that. Then we have the principal transactions or average trading assets growth. So this is 3.1, 2.1 over the year. Then 2.5 is a constant one for the future years. Then we have the lending or deposit fees. It's a 0.3x or something like that. Then we have the assets under the supervision. So these are the assets under the supervision for the projected one. Then we have the asset management fees. So average fees is 0.8% to 0.6%. And then we have the 0.7% as a constant one. Then we have the mortgage and home loan equity, credit card receivables, and other incomes are there. Then we have the no interest expenses, like whatever the expenses are there. So these are the non interest expenses for a period. And then we have the compensation expense or the occupancy expenses, whatever is here. Then we have the technology equipments and the professional services, marketing and other expenses. So this is the effective rate for the particular company, and these are the occupancy for that. So these are the some of the parameters for anything. We can go ahead with that, or we can work on the different parameters for that. So let's discuss in the next video regarding the most of priority of the videos.